Good morning. It's 11 o'clock here in Copenhagen. Time for our Monday webinar. It seems to be a kind of a tradition. We hope it will soon end because that will indicate that the war is over. Today with me I have Udayan from our trading, Sean from our supplying unit in Dubai, and Manya from Middelfart, our head of our biofuels at Bunker Holding. As always, you can ask questions using the Q&A button at the top, and then there will be a curtain to your right hand side, and you can write questions anonymously if you like, or you can also put your name in. But let's get on with the webinar. I think we are over the weekend. We have seen more escalations. We are now trading around 116 for the front month Brent contract. Do notice that there's a lot of backwardation in the curve. So when we roll into the June contract, we'll drop to around $108, $109, but it's purely due to roll of contract. If we look at the dated Brent, which is a cargo in April, we're trading well above $120 for Brent. We had the extension of the deadline for the destruction of the power infrastructure of Iran on Monday, 10 days, but it's very hard to see any change over the weekend. We have seen attacks on heavy water facilities in Iran. We have had power outages in Iran. We have seen Iranian attacks on aluminium production in Bahrain and in the Emirates. We have seen more focus on land troops moving to the Middle East, and we have a lot of talks about peace talks, but in reality it is mostly talks. My personal opinion is that there's very, very little communication going on between the US and Iran. Of course, a lot of focus on the Strait of Hormuz. There are a few more ships coming out of the Strait of Hormuz. There are some agreement apparently with Pakistan, Thailand, but it's still a drop in the ocean, so to speak. And then something I've noticed this week or last week is that the market respect for Trump's tweets are getting smaller and smaller. We saw it on when this about the delay was announced. Prices dropped, but it only took a few minutes, and then prices moved right back up. So overall, a clear escalation since our last call. I think one of the biggest escalation is that we now see the Red Sea much more being impacted into the crisis. We have the Yanbu over here. Roughly 5 million barrels of oil per day is transported by Saudis across the Saudi Arabia onto the Red Sea, and then it goes by tanker through the Strait, through Asia. During the weekend, the Houthis attacked twice Israel. They have no official sort of saying that the Strait is closed, but I think that is a very likely next escalation point, that the Houthis will be saying that they can no longer guarantee the security of the Strait of Hormuz. What will that indicate? It will indicate that the oil from Saudi Arabia will have a hard time going south. It will have to go through the Strait of Hormuz. The big VLCCs cannot go through the Suez Canal, and if you go north through the Suez Canal, it will take at least 25 days more to reach Asia, which is the sort of the corner of the oil or the oil problems. The situation in Asian countries are much more severe than in Europe, and of course in the Northern America, it is Asia that are being hurt the most, and that will be felt very, very hard if they manage to close the Bab al-Mandab Strait. So keep an eye out for any comments from the Houthis that they are now engaging directly with shipping in the Red Sea. At this point, I would like to invite my colleague from trading, Udayan, into the discussion. Udayan, what we see here is to the left-hand side is the so-called cracks. So that's the difference between 1 barrel of Brent and 1 barrel of product. and we see the same pattern. We see jet fuel very expensive, VLSFO very expensive in Singapore. ICE gas oil also crack also very elevated. But we also see, for example, the crack for VLSFO in Rotterdam is actually more or less at the same level. And to the right, you see the so-called east-west spread. So that's the difference between one metric ton of VLSFO, 1 metric ton of jet fuel, 1 metric ton of ICE gas oil between Rotterdam and Singapore. So, Diane, what's the pattern here?
Morning, Arne. Morning, all. I think the situation is pretty similar to what we spoke about last week. We have the physical side of things is dire as it stands, and what we said last week was even without any further escalation, we would expect the market to keep grinding higher, and that's what it's doing right now. Of course, as you say, there's potential for more escalation, especially if the Red Sea comes into play. But as far as Europe goes, the distillate situation is dire, and the east-west spread means the refinery economics are geared towards more. In any cargoes that do come will be favored to go to Asia instead of Europe. So that doesn't help the distillate situation in Europe. As far as the fuel products goes, it's the same story. The east-west spread on the fuel side are skyrocketing, so cargoes will economically flow towards Asia, all else being equal than Europe. On the high sulfur side, we can see that US has recently found a lot of supply from Venezuela. They also have heavy oil coming from Canada. So the ARB economics from the US to Europe are still positive. But of course, the Asian ones are still higher, so you would still expect more cargoes to go to Asia, but the freight situation might be against that. The 0.5 is a bit of a peculiar case, and we're still trying to understand what's going on there, because the US 0.5 is, let's say, the front month cracks are at 13. The Asian ones are at 20. For some reason, the European ones are at -2. So it's nothing to do with the ARBs. You wouldn't expect with these crack levels a lot of US cargoes to be landing in Europe. The European 0.5 looks particularly cheap to me, given everything else.
Diane, I think that's also something that if you are exposed to 0.5, this actually is one of the opportunities that we can point to in the market. And also because the forward curve is actually still in backwardation for 0.5.
Just from a purely relative value play, I can't make sense of why the European 0.5 is so low, given the high sulfur. You could still argue, as I said, there's ARB economics from the US to Europe, but the 0.5 just doesn't make sense to me.
Yeah, and here you see the difference in flat prices between Singapore and Rotterdam. And do remember, this is 1 month prices. The picture is a bit different if we talk about the physical delivered prices. I don't know if you have anything to add here, Udayan, to this slide.
No, I will just say on the distillate side of things, on top of the, as you mentioned, Arne, on top of the dire situation in Europe, if the Red Sea comes into play, that makes things a lot worse, because then things need to go around the Cape, and that makes everything a lot worse. So let's keep an eye out on what the Houthis have to say.
And especially again, Asia will be the most hit here. Actually, you could imagine that there will actually be more crude oil products coming to Europe through the Suez Canal, but the situation in Asia will be a nightmare.
Yeah. And as it stands, the East-West gas oil spread is already, I think it's touching 150, 160. So it's already very, very high.
Yes. Thank you, Udayan. This time let's touch upon the gas market as well. Of course, we are all aware of the LNG outages in the Persian Gulf. The Qatar is completely shut down, the Ras Laffan, and we have this disruption of 17 of the capacity see 2 of the so-called 14 trains of LNG, you call it trains, there are 14 of them, have been destroyed. And QatarEnergy has been out saying that it will take between 3 and 5 years to re-establish production at these trains. And we should probably also forget about any extra LNG coming out of Qatar. New investment, all investment will be focusing on bringing these 2 trains back online. I wouldn't be surprised, I'm afraid, that if we see escalation, Iran may try to target more of these trains in Ras Laffan. At the same time, we actually have a significant outages in Australia. So at the moment, roughly 25% of all global LNG is actually not coming to the market. Of course, what's happening in the Persian Gulf in Qatar is the most important thing to follow. So the picture is, and also as we discussed last time, is still that the dark one, the thick one, the spot price, we're around this 55 level. But importantly, the curve is completely flat. So the narrow dark one, black one, is prices for the last 6 months of the year for TTF. The flat curve means that it's very expensive to do the refilling because there's no incentive to buy cheap over the summer and sell expensive during the winter. The summer-winter spread is basically working against the buyers. Also with prices doubling, of course, you need more financing to finance stock building, and you really need a lot of stock building. This is my favorite chart showing the inventory situation. This is for Belgium, Netherlands, France, and Germany. We only have 100 terawatt hours in inventories, and you can see the last couple of days we have actually moved slightly lower. Normally, you would start to move higher at this point in time. We are somewhat below the level in 24, 23, but we are well below the level in 22 and 23. Sorry, this is dark one is 25, 24. So quite a nervous situation in the global gas market. We need to refill, and we lack LNG. LNG prices are still higher in Asia, the same as in the fossil fuel, meaning that there is still an incentive to ship LNG towards Asia. And the only way Europe can refill inventories over the summer, during the spring and over the summer, ahead of next winter, will be to bid up prices. So I think we are looking into a bidding war. And if I were a consumer, I know it's a very high price, but I would strongly consider locking in, at least for the rest of the year, the price risk, even though it is at an elevated level. But it's just very hard to see a solution to this because the summer-winter spread is working against you. The demand from Asia is working against you. And on top of that, we have the uncertainty with the Russian gas. Just notice that the red one here is calendar 27, and that this one is calendar 28. We continue to edge higher in these long end of the curve, and that is, of course, because the whole narrative about the LNG market has changed. We are no longer looking into a market being abundant with LNG, but we are looking into a tight market for at least 2 or 3 years, or perhaps even more. So it's a severe situation there. But this market is also, of course, something from a buyer perspective, that are actually a few opportunities out there. And to talk about that, I would like to invite our head of biofuels from Bunker Holding, Manya. Can you say a few words about how the biofuels market is doing?
Yes, thank you, Arne, and good day to everyone. Appreciate to get some time to shift a little bit the focus to the biofuels market, because the biofuels market is obviously also affected by the volatile prices, oil prices, and especially the gas oil complex. We've seen over the last 4 weeks quite a strong decline on premiums of biodiesel over conventional fuels, especially gas oil. We saw 4 weeks ago still a premium of FAME biodiesel, FAME Zero over gas oil of more than 400. which declined now to $70 a ton. And it made me actually think over the weekend if we could eventually even see negative premiums of the FAME Zero over the gas oil. So that would be interesting to watch. But there's definitely quite a compression on the premiums that we've seen over the last weeks, which means there is a very low abatement cost of biofuels over conventional fuels at the moment. For ship owners and operators, it's a great opportunity to lock in the current levels, to be fully maritime compliant, especially now is the period when a lot of ship owners and operators are usually going to the market and trying to cover their compliance. And it's a good timing because we see also going forward the gas oil degradation and potentially a stable to even stronger biodiesel price overall, meaning that this opportunity will close at some point. Obviously, if we see a stronger prices, which we see at the moment, and if that continues, that will keep the window open for a little bit longer. But overall, we see that the market is demanding less biofuel, especially on the marine side. We see a decline in demand. We see that ship owners and operators are very much focusing on the price volatility, on dealing with the price volatility on conventional fuels, and also on operational challenges. If we look at Singapore, for example, there is not a lot of biodiesel being bunkered at the moment, especially also with the high VLSFO premiums we see there. There is a good utilization or the utilization of the operational barges there, of the bunker barges are mainly used for the conventional fuels and less for biofuels. So overall, there is surprisingly low demand of biodiesel, and this is just to bring up the opportunity. The abatement costs are low, and it's really the right time to buy for fully maritime compliance. If we look into the next couple of weeks and months, you see here, just talking about the abatement costs, you see here actually it is cheaper to buy biodiesel at the moment in the Netherlands. If you include the ERE discount, it is cheaper to buy B30 or even B100 biodiesel in the Netherlands compared to conventional gas oil. We see negative or compliance costs actually of negative 36 for a B100 FAME and 74 euros per ton CO2 equivalent for a B30. And this is really cheap. And remember also that you can create a surplus that you can then either bank or sell back to the market. So creating that surplus now is very cheap. So it can be even an additional revenue stream or a banking opportunity for ship owners and operators. This is the gas oil complex. If we move to the next slide, Arne, you see the abatement costs and also the cost of compliance for VLSFO. Obviously, the premium is still higher, but overall, there is also quite some pressure on that premium over VLSFO of biodiesel. If we look forward, seasonally, there should be more demand coming now for biodiesel from the road transport and also from the marine sector for fully maritime compliance and voluntary demand. But what we see at the moment is that the biodiesel flat price is not increasing, is not really correlated to the gas oil. So this pressure on the premiums really is an opportunity. Going forward towards Q3, we see biodiesel quite flat. The flat price is quite flat going into Q3. So depending, obviously, this is very much driven by the gas oil complex, depending on what gas oil is doing, that opportunity might vanish, and very likely it will vanish because the market at some point will normalize again. We need to watch out for potentially lower demand that could maybe affect production rates or production capacities that could then stabilize biodiesel premiums again, could lead to a higher price. As I mentioned, we are thinking, will the premium, could potentially the FAME gas oil premium turn negative? I think if it does at all, we've never seen that so far in the market, but if it does, it will be just for a short moment because the market will balance out. If biodiesel is just too cheap, production capacities will be reduced, and that will also stabilize biodiesel prices. Seasonally, we see more demand of biodiesel from the road transport, especially at that time of the year when we're shifting to the summer specification. Obviously, if fuel prices are staying high, we might see a decline in transportation, maybe also less fuel consumption during the holiday season, which is usually a high fuel consumption season in the summer months. So that could also affect biodiesel prices, and we need to watch that. And another complex or another component that we are closely watching is, of course, also some countries that have export bans of certain products, not biofuels, for example. China, they have put export restrictions already on some of the fuel products that might at some point also come for biofuels. And China is still, for example, an exporter of biofuel that is going to Singapore for that market. So these are all events that we need to watch closely. But overall, the positive news here, and just to round it up, is there is an opportunity now to log in very low abatement costs for biofuels for the marine clients. And with that, I'll hand over to Sean.
Super. Thanks, Manja. Yeah, I think obviously we've come in today, and if we look at the slide here, we've all come into a much higher flat price. The volatility continues across all the main bunker hubs on pricing, but one thing that we are seeing from China, Singapore to Fujairah to ARA is the second week of March was certainly the peak, both in terms of the flat price and the relevant premiums to their local cargo indexes. So we are seeing a dramatic drop in the last 5 to 7 trading days of bunker prices. We obviously see that the bunker stems in certain ports are actually increasing. So notably in China, we do see actually an increase in bunker requirements, particularly from the container segment. But the theme across Singapore and Fujairah is certainly that demand has come off. Inquiries are slower, as are some of the stem sizes that we are seeing. But disruption continues because we obviously see that the situation remains fluid. There was obviously some incidents here in the region, notably the port of Salalah. So this is obviously altering operations. It's putting a suspension on some bunkering in certain ports that we particularly saw in the earlier parts of the conflict. And this obviously delays some bunker operations, but it also alters last minute any orders that are in place, as vessels and buyers then look to secure volume in what is considered safer and cheaper regions. Some of the winners of this, we certainly see that particularly in East Africa, such as Port Louis, West Africa, they're seeing significant increase of bunker demand. And if we look at the next slide, please, Anna. What we do see is that the impact to trade is already there, and the longer this conflict goes on, the more disruption we will see. Obviously now the Red Sea, with the focus over the weekend, can be significant for commodity flows, but also for bunkering. The Red Sea, particularly with the amount of VLCC loadings in Yanbu, saw a significant increase of bunker requirements that potentially can taper off dramatically should we see some volatility and hostility across the Suez Red Sea region. It's worth noting that, you know, in the Middle East, 6% of total oil demand is from bunkering. To put that into context, it's around 75,000 tons per day. But we also do see a significant amount of fuel exports that transit the Suez. That's around 21% of global exports. And if we then look at the Strait of Hormuz, which we've talked about previously, you know, more than 600,000 tons per month of VLSFO and 500,000 tons per month of high sulfur transit the Strait of Hormuz, which is more than enough to cater for all the bunker requirements in the Middle East, with much of that also going east to Singapore. So we do see significant tightness occurring in certain ports, notably in Singapore, the longer this conflict continues. April is looking very unclear. Cargoes are limited, offers are few and far between in some of the hubs. Even if you look into May, the picture becomes even more opaque. So please do consider that when you're making your bunker planning. And I will leave it there. Thank you, Anna.
Thank you, Sean. And remember, you can ask questions, use the Q&A button at the top, and then there will be the curtain to the right. We actually received a few questions in advance before the webinar. Maybe Sean, you can come in here. If the Houthis block the Bab al-Mandab Strait, could that in practice make the European markets cheaper than the Asian markets? How do you see that? We already saw the cheap VLSFO, and we have this east-west spread, but do you think this could actually intensify this price differential?
Potentially. So what we're seeing now, particularly with the closure of already the Strait of Hormuz, VLSFO barrels are now looking towards Brazil, towards Russia, to fill the gap that would normally come from, say, the Kuwait Al Zour refinery. So potentially, yes, Europe could benefit in the short term, but overall, the closure of the Red Sea does impact most of the bunker hubs, and we'll all start to see a bit of an increase. But short term, yes, Europe could gain from cheaper pricing versus Middle East or Asia.
Yeah, thank you, Sean. Udayan, do you have any comments there, except what you already said?
Yeah, I mentioned this already earlier, so I agree.
Then there's a question about different price scenarios regarding the ending of the war. I think there's if you want to do these scenarios, we also try to do that, but it's a bit of a guesswork. What I think I can say is that I think the market is still underestimating the timeline before this ends. Of course, when we get kind of a confirmation that the war is over, that the Strait of Hormuz will reopen fully or partly, we will see a drop in flat prices. But this is priced in the forward curves to a large degree, so it will mainly be in the front end of the curves. I don't think we'll move back to prices before the war started, because we have destruction of refinery capacity, we have destruction of ports, we have oil production that may not recover as quickly, and we have a whole shipping situation that has to sort itself out. I think it's 2,000 ships trapped inside the Persian Gulf just before they get out. It will take quite a long time, and there's no guarantee that we will have a safe security situation after the war ends. So, but of course, if the war ends, we will go lower, and we'll probably see a dip below 100 in Brent, or probably lower, and then the market will start to sort of look into what is the long-term consequences here. There's one market where we are concerned that we will not drop any significantly, and that is, of course, in the gas market, because we have long-term implications there. So scenario is, and of course, as the war ends, we'll go back maybe to 90, 100, maybe 80 if we are lucky. I don't think we're going back to the 60, 70 level. Then there is the scenario where the war ends, but it ends in a situation where the global economy is actually pushed into recession. In that situation, we could, of course, have significantly lower oil prices. Then we could move back to the level before the war, or even lower. But that would be in a situation where you have a severe recession. On the upside, if the war extends, we are probably approaching levels where we see what we call demand destruction in jet fuel, for example, in some gas. So the market can barely not bear higher prices, but I still think we are in for higher flat prices over the next month or two if the war doesn't stop. But we are approaching level where you see demand destruction. The economy reacts to higher prices, and that's a question of the oil storage industry. I think it's a bit out of our scope, but what I can say is that there's a big issue, especially in the Persian Gulf, that there's basically no oil storage left. And of course, after the war, there will be focus on how to rebuild even bigger strategic inventories. And there's a question here: given escalating geopolitical tension and the risk of a ground invasion, would such an escalation ultimately increase or reduce long-term risk premium in the oil and gas market? I think it will tend to increase the long-term risk premium in the gas market, especially if we actually end up with an Iran with a very unstable Iran. There are geopoliticians who have been talking about a kind of a failed state where you will have random attacks on shipping, trying to take advantage of ships going through the Hormuz Strait and so on. So yes, I think there is a risk that will have implication for long-term risk premiums. I think that was more or less the questions we had for today, and time is also running, so I will call it off for today. Thank you for calling in. We will it is bank holiday on Monday due to Easter in Denmark, and I sincerely hope we will not need more of these webinars. But if the war continues, if the uncertainty continues, we will of course be back with our updates. Thank you for listening in. Thank you.